Okay, so I'm back to continue my studies. So, commencing studies, jumping right back into it. In order to determine insurability of the applicant, the insurer must use several sources such as Medical Information Bureau or MIB report for gathering underwriter information. Applicant must be advised of the sources to be used and how the information is gathered. All sources used to verify insurability must adhere the Fair Credit Report Act. So it's jumping into attending physician report. If the underwriter deems it necessary in attending an attending physician report or statement, APS will be sent to the applicant's doctor to be completed. This source of information is the best for accurate information on the applicant's medical history. The physician can explain exactly what the applicant was treated for, the treatment required, the length of treatment and recovery, and the diagnosis. So that is attending physician report. Number 2, medical exam report. Medical examinations, when required by the insurance company, are conducted by physicians or paramedics at the insurance company's expense. Usually, such exams are not required with regard to health insurance, thus stressing the medical exam, or stressing the importance of the agent in recording medical information on the application. The medical exam requirement is more in common with life insurance underwriting. If an insurer requests a medical examination, the insurer is responsible for the cost of the exam. If an insurer requires an applicant to take an HIV test, the insurer must first obtain the applicant's written consent for the test. The consent form must explain the purpose of the test and inform the applicant of the confidentiality. Oh my gosh, I can't talk. Confidentiality of the results and procedures for notifying the applicant about the results. Underwriting for HIV or AIDS is permitted as long as is not unfairly discriminatory in adverse symptoms, but only HIV. If HIV is confirmed in relation to the symptoms, insurance companies must maintain strict confidentiality regarding HIV related test results and diagnosis. HIPAA, privacy. Oh, we know HIPAA. Under the Privacy Rules for HIPAA, Health Insurance Portability and Accountability Act, protecting information requires all individually identifying health information held or transmitted by a covered entity or its business associates in any form or media, whether economic, paper, or oral. It is called Protected Health Information, PHI. Individual identifiable health information includes geographic data that relates to past, present, or future physical or mental health or condition, or payment information that could easily identify the individual. A covered entity must obtain the individual's written authorization to disclose information that is not for treatment, payment, or healthcare operations. Policy delivery. Now we're moving into policy delivery. The agent has a responsibility to deliver the policy to the insured and collect any premium that may be due at the time of delivery. Next section, explaining policy and its provisions, riders, exclusions, and ratings. The agent has a responsibility to provide the insurer with an explanation of the policy's main benefits and provisions. If the policy is issued with any changes or amendments, the agent is required to obtain these changes and obtain the insured's signature acknowledging receipt for these amendments. E. Replacement. When an agent attempts to replace the insurer's current health insurance policy with a new one, the agent needs to be careful not to mislead the insured or provide coverage that is to the insured detriment. I can't read. It is the agent's responsibility to carefully compare the benefits, limitations, and exclusions found in the current and proposed replacement policy. The agent also must make sure that the current policy is not canceled before the new policy is issued. Know this: there cannot be coverage gap between the existing coverage and replacement coverage. Dun dun dun. I'm trying to get centered here. And yeah, I'm slouched over. Okay. Pre-existing conditions are a very important consideration when replacing a policy. A pre-existing condition is a medical condition for which the insurer sought medical advice or treatment within a specified period of time prior to the policy issued. Health conditions covered under the current policy may not be covered under the new policy because of pre-existing condition limitations, or new waiting period may be required in a new policy. While the Affordable Care Act eliminated policies that may still apply to Medicare, long-term care, and disability income coverages. Underwriting is important when replacement is involved. It is an underwriter's duty to evaluate risk and decide whether or not a person is eligible for coverage. The insured may be under the assumption that a replacing policy is in his/her best interest, but after being evaluated by an underwriter where premium and risk are exchanged, an insurer may not be paying the same premium or receiving the same benefits. Dun dun dun. Next. Chapter Recap. This chapter explained field underwriting procedures for health insurance policy. Let's recap them. Contract law. Elements of a legal contract. All the following requirements apply: agreement, consideration, competent parties, legal purpose, adhesion, where one party prepares the contract, the other party must accept it as it is. Aleatory, exchange of unequal amounts. Conditional, certain conditions must be met. Unilateral, only one of the parties to the contract is legally bound to do anything. Explaining sources of insurability information. There is the attending physician report, which is best for accurate information on the application medical history. MIB report helps companies share adverse medical information on insureds. There is credit reports, contain factors related to a risk potential for loss, include consumer reports, information regarding the consumer's credit, character, reputation, or habits collected from public sources, and investigative consumer reports, information obtained through an investigation and interviews with associates, friends, and neighbors of the consumer. Also, there's medical exam report, conducted by physicians or paramedics. Initial payment and receipt. Effective date of coverage. If the premium is not paid with the application, the agent must obtain the premium and a statement of continued good health at the time the policy is delivered. Replacement. This is an agent's responsibility to compare benefits, limitations, and exclusions found in the current and the proposed replacement policy. Ensure that the current policy is not canceled before the new policy is issued. A producer must also be licensed for both securities and life insurance in order to sell variable universal life. Reputation of variable products, SEC, FINRA, and state. Variable life insurance products are duly regulated by state and federal government due to the element of investment risk. The federal government has declared that variable contracts are securities and are thus regulated by authority, FINRA, regulated by the Securities and Exchange Commission, SEC, and the Financial Industry Regulatory Authority, which is FINRA. Variable life insurance is also regulated by Insurance Department as an insurance product. Agents selling variable life insurance products must be registered with FINRA, be licensed by state to sell life insurance, and have received a securities license. Interest-sensitive whole life. Interest-sensitive whole life, who referred to as current assumption life, is a whole life policy that provides a guaranteed death benefit at the age of 100. The insurer sets an initial premium based on current assumptions about risk, interest, and expense. If the actual values change, the company will lower or raise the premium cash value with the current interest rate that is usually comparable to money market rates and can be higher than the guaranteed levels. The policy also provides for a minimum guarantee rate of interest. Interest-sensitive whole life provides the same benefits as other traditional whole life policies, with the added benefit of current interest rates, which may allow for either greater cash value accumulation or a shorter premium paying period. Index life. The main feature of index whole life or equity index whole life insurance that is the cash value is dependent upon the performance of equity index such as S&P 500. Although there is a guaranteed minimum interest rate, the policy's base amount increases annually to keep pace with inflation as the consumer price index increases. Without requiring evidence of insurability, index whole life policies are classified depending on whether the policy owner or insurer premiums increase with increases in face amount. If the insurer assumes the risk, the premium remains level. Policy compared. So, adjustable life coverage. The key feature can be term or whole life, can be converted one to the other. Also, with adjustable life, premium can be increased or decreased by policy owners. Base amount is flexible, set by the policy owner with proof of insurability. Cash value. Fixed rate of return, generally account. Policy loans can borrow cash value. You can borrow money from adjustable life. Universal life. The key feature is permanent insurance with renewable term protection component. The premium is flexible and minimum or target. These are stuck together. They're giving a little picture here. Under option B, increasing death benefit option, the death benefit includes an annual increase in cash value so that the death benefit gradually increases each year by the amount that cash value increases. At any point in time, the total death benefit will always be equal to the face amount if the policy face amount of the policy plus the current amount of the cash value. Since the pure insurance with the insured remains level for life, the expense of this option are much greater than those for option A, whereby causing a cash value to lower in the older years. Variable whole life. I feel like this is, oh, this is backwards. Okay. So option B, again, increasing death benefit option. Option A is level death benefit option. The death benefit remains level while the cash value gradually increases, thereby lowering the pure insurance with the insurer in the later years. Notice that the pure insurance is gradually decreasing as time passes. Lowering the expenses and allowing for greater cash value in at a later point in time. Is so that the policy will comply with the statutory insurance contracts issued after December 31st, 1984. According to this definition, corridors are established in a table by the IRS and vary as the age of the insured and the amount of coverage. If the courier is not maintained, the policy is no longer identified as life insurance for tax purposes and constantly loses most of the tax advantage that have been associated with life insurance. Okay. Now, variable whole life, variable insurance, sometimes referred to variable whole life insurance as a level fixed premium investment-based product. Like traditional forms of life insurance, these policies have fixed premiums and a guaranteed minimum death benefit. The cash value of the policy, however, is not guaranteed and fluctuates with the performance of the portfolio in which the premiums have been invested by the insurer. The policy owner bears the investment risk in variable contracts. Know this, in variable contracts, the policy owner bears the investment risk assessed in a separate account. Because the insurance company is not sustaining the investment risk of the contract, the underlying assets of the contract cannot be kept in insurance company general account. These assets must be held in a separate account, which investments in stocks, bonds, and other security investments options. Any domestic insurer issuing variable contracts must establish one or more separate accounts. Each separate account must maintain assets in a variable with a value of at least or equal to the reserves and other contract liabilities. Assets in a separate account cannot be commingled with assets on the general account. Variable whole life. Ugh. Variable universal life. Variable universal life is a combination of universal life and variable life. Like universal life, it provides the policy owner with flexible premium and an adjustable death benefit. Like variable life, the policy owner, rather than the insurer, decides where the net premium cash value will be invested. Also, like variable life, the cash values are not guaranteed and the death benefit is not fixed. The cash value and or death benefit may increase or decrease over the life of the policy, depending on the investment's performance and underlying sub-account. The death benefit, however, generally cannot decrease below the initial face amount. Regulations of variable products. That is SEC, FINRA, and state. I read that. Okay. Okay. Let's get into know this. If an insurer skips a premium payment on a universal life policy, the missing premium may be deducted from the policy's cash value. The policy will not lapse. A universal life policy has two components: an insurance component and cash account. The insurance component of a universal life policy is always annual renewable term insurance. Universal life policy allow the partial withdrawal, partial surrender of the policy cash value. However, there may be a change for each withdrawal, and there are usual limits to how much and how often a withdrawal may be made. During the taxation, depending on the plan, the death benefit may be reduced by the amount at any particular or any partial surrender. Note, however, that the partial surrender from universal life policy is not the same as a policy loan. Universal life offers one of the two death benefit options to the policy. Option A is a level death benefit option, and option B is an increasing death benefit option. So we talked about A and B. I think we're gonna pause right there while I gather these papers and know what the next topic will be, which looks like it's going to be riders and annuity. And then we're good.